me that's where it began. Just essentially, having passion to analyze. You have to constantly be analyzing to find, what's next and also, what's on the fringes of the companies you own. How can you find alternative data sets that potentially lead you in the right direction? But ultimately just having a clear framework of where you're even looking for. I don't want to, knock down the door of all 500 of my clients and tell them to sign this paper for, a 3% sliver of their overall portfolio or a 7% sliver. So, what's the easiest access point? There's this narrative that's out in the world today. It's not a narrative, it's reality, but it's, the AI hype. And we think actually maybe some of the best opportunities are the ones that are being improperly hit.
Welcome to this week's Raz Report. We got Sean Emory, founder and CIO of Avory Company, an investment management firm. He has his own podcast, Inside Scoop Pod. You can follow him on Twitter at _Sean David, SeanDavid. So David must be your middle name.
David is the middle name.
All right, because you got Sean Emory, but Sean David is the Twitter. Okay, right?
I was late to the game, right? So Sean Emory wasn't just available.
Maybe you were late to the game, or you're just a youngster. How old are you?
34 now.
Yeah, you're a youngster. And you live in Miami?
Miami, Florida, born and raised.
All right. Oh, okay.
One of the few.
So yeah, most people are here. So now tell us what you do.
Yeah, look, at Avory, we're an asset manager in Miami. We run high conviction equity portfolios. We have three main strategies, one being our flagship, which is, a high conviction called Premier Growth. 8 to 25 companies in that portfolio, generally around 15.
Is it evenly distributed capital, or is it allocated to more conviction ideas in that portfolio? How do you do it?
Yeah, so we start off at an equal weight, and the reason why is we're behavioral psychologists at heart in some degrees, so we believe that we have natural instincts to overweight some of the winners or some of our favorites. How about to say the least? In the portfolio. So we start at equal weight and then we let them run, and then we have pretty wide bands on when to snap them back to, that equal weight philosophy or mandate.
Okay. So you have three different strategies. High conviction. What are the other two strategies?
Well, they're all high conviction. So the firm is based on high conviction, right? So, Premier Growth is, so our two first strategies, Premier Growth and Premier Plus, right? They're the same strategy. The only thing we're doing is lowering the return threshold to get more in the door. It's much more of call it diversified, but it's 25 stocks and basically 25 to 30. And we call that a diversified version of our, highest conviction strategy. Secular growth, transformation stories. That's ultimately what drives our boat. At Avory, again, not to be promotional, but it's our philosophy is investing where the world is headed. This is pre-2020. We had this philosophy, before that became, popular, let's say. So secular growth on one side, 11 themes that we're investing behind, and then, transformation stories, which are companies that are going through their investment life cycle or company life cycle and ultimately transforming their business to better realign to where the world is headed. So that's the first two. One is Premier Growth, Premier Plus. The only thing there is return thresholds, and that allows some in the door. And then Dividend Compounders, which is actually, we go down the same substrate of investing where the world is headed. Same companies are approved. Who's paying a dividend? We think if you look at dividend growth strategies today, many of those are filled with, legacy type philosophies and legacy industries. And generally speaking, where the world is headed on the dividend side is, many of these cash hoard companies are going to be the dividend payers of the future. But they don't meet the strict mandates of, 10 years of compounding dividends and such. But there's clear line of sight in those. Of getting there. So, we think that ultimately it was from demand from the advisor community that wanted our philosophy in that type of a strategy. So that's ultimately how it evolved.
Okay. Now just skipping to you, because I read your newsletter. You have I don't know if it's a newsletter or a research report, but I read one of your reports, and you talk about some of your stocks, Wix, Omnicell, Nunetics, Meta, but I loved reading about the Fed rate, like where the rate was, the history of it, and just your overall take on the markets. What have you always been passionate about the markets? Have you always been a guy following them? You said you're 34. Where'd this passion come from?
Yeah, I mean, I say a funny story, but it's also reality, which is I played fantasy baseball when I was 10, 13, 12, years old.
Yep.
And that's that same philosophy approach, which is, continuing to dig,
Yep.
find something when it's cheap and, sell it when it's A-Rod. And, finding the 18-year-old and, selling them when they're 26 on about to hit, 30. And so that type of analytical kind of, let's say, capabilities, I think that's where it morphed, and the passion for just discovering. And then from there, I went to Stetson University in Central Florida, a really, really good investment program where I was an analyst, a trustee of the endowment while being a student. We were running a high conviction equity portfolio there, and became a small cap equity analyst at the leader of that group's hedge fund for some time. And ultimately, that's where it began, which was just essentially having passion to analyze. I think that's it's a requirement in our field. Because you have to constantly be analyzing to find what's next, and also what's on the fringes of the companies you own. So I would say that's the general origin story of the passion.
Got it. And so is your like role like being an investigator, almost finding those undervalued companies when no one's looking at them?
Yeah, for sure. And obviously the investigation part has evolved over time, where it's, how are you looking for these opportunities? We all used to, back in the day, people would look at the newspaper and, there was some arbitrage between waking up maybe a little bit earlier and looking at PEs in the newspaper and seeing, what went down and what went up. Morph that to today, everyone has Yahoo Finance and can screen for the perfect company. So there's really no arbitrage, screening for, sub 15 PE, 20% revenue growth, 20% margins. That doesn't sound like an area that you would want to, attack. So how can you think differently about maybe a screen? How can you find alternative data sets that potentially lead you in the right direction? But ultimately just having a clear framework of where you're even looking for, and what you're looking for. And that's why we designated our philosophy on secular growth and transformation, where we're at the two tails of, a company's journey, which is, the very early start. And I don't mean, when they're private and early and no revenues and no profits, things like that, but disrupting incumbents. And then on the other side is really, them disrupting themselves. They are the incumbent now, and they have to morph and evolve. And, so I think that's ultimately, having a clear philosophy of what you're looking for, and then realizing that, some of these things are going to change over time, that the newspaper is no longer your advantage, that Yahoo Finance or screeners are no longer your advantage. So what is that next advantage that you could potentially have in finding ideas?
Okay. And so your funds, how do they compare like to the S&P?
In terms of
I mean,
everything in general?
Maybe the S&P is the wrong question. What I mean is, like, you have a more concentrated portfolio. You're picking stocks. How do you compare to the indexes that you go against or what have you?
Yeah, it's pretty interesting. So, if you just decompose our strategies, and it's by chance, but it's essentially, we have zero in the Dow, zero holdings in our strategy or in the Dow. We have less than 12% in the S&P 500 and less than 12% in the Nasdaq. So by nature, I think trying to find dislocated assets that are either people are underestimating their future growth potential because there is this secular tailwind that's going to drive growth in the future, or they're kind of unappreciating the transformation that is underway or about to occur or occurring. And generally speaking, those two tend to, I mean, for some reason, we don't own that many in the indices.
Okay.
We've never been within 10% of an index, using like those main ones as the proxies. So we want people to look at us as truly as an investment that is kind of on the side of, of what they're doing, whether in the real world with real estate, and also, whether it's, what they have an equity portfolio and, they want to get beta exposure through SPY, but they want something else that, they trust the process, the people, and the performance over time has served them well.
So how many years have you been doing the strategies for?
Yes, 6.5 now, almost 7.
Okay, and
It's been a little
so
bit.
have you ever thought of creating an ETF?
We have. We're actually in the process of active ETF
Okay.
discussions through demand. It's these advisors want simplicity of implementing inside their portfolios. We run separately managed accounts, and if you run a fund or a separately managed account, those can be tedious for each next investor that you have at the RIA channel. The advisors that are trying to have 500 accounts and trying to implement a strategy across 500 accounts, and active ETF just makes a lot of sense.
So do you at Avery and Company, do you have a lot of families? Like, do you reveal what's your AUM? I mean, you're a young firm. It's awesome. Started, I mean, you have one co-founder, I think you said.
Yeah. So it's myself and a co-founder.
So you have, yeah. So do you guys, is most of your are most of your clients families? Is it individual? Like what do you focus on?
Yeah, really. Yeah.
Because
High net worth.
you're pretty prolific, like social media wise, and I'm sure people can reach out to you that way. I just like, how does it, it's a different world these days, right?
Yeah. You'd be shocked that the social channels, we put a lot of our research out there. So we've gotten a lot of, response to that. We believe in that concept since day one. That's what's got us. I used to run a blog that became pretty popular, and that gave us some reach. Then we developed. That was like 10, 15 years ago. So I always had like some reach. At some point, Avory, our client base, our investor base, we have super high net worth individuals. You're talking, families worth, 50, $100 million or more. In some of those, we have a large chunk. In some of those, we have a small chunk of their assets, liquid assets. We also have, some of the advisor channel, which is kind of where we are today in terms of our growth, where we have big families that we're strategic about, that we want to work with them. They want to work with us. We've gone through many years of talking to each other, seeing everything, and reading our research. And then the next phase as well is around distribution. Which product distributes better? We think we're in a different world again than 15 years ago, where you couldn't have separately managed accounts really because it was tedious to make those trades. But also on the ETF side, you didn't really have like the active side of ETFs being as, call it, desired, or the knowledge. There was kind of this knowledge gap where ETFs were only passive. So that's it's changing, but that's the structure of our firm today. Is we work with high net worth individuals. That was the early days and still today. And then the RIA channel that we're going after now in terms of wanting to work with and just figuring out the best ways to do so. We actually don't have a big at all retail following in investor base. I don't know if it's our call to action, whether it's on the websites and making it easy. Separately managed accounts, they're not as streamlined, so could be that.
So you're saying you guys go reach out directly to RIAs to help them manage some of their clients' money?
Yeah. So we have a good handful of like advisors that work at different institutions across the country. We're everywhere from Scottsdale to California to parts of Florida to Puerto Rico, where we have advisors that are there to Atlanta, and they'll put their investors, their advised clients, into our strategies in different proportions. Some cases we don't know the proportion, but some cases we do.
Well, how do they do it? Do they have to do they just set up a separate account with like their SMA or like a Fidelity, and then they use your strategy? Is like your strategy there? Like what's the actual so what I guess I'm asking is, someone's listening to this podcast today, the Raz Report, and they see and they want their advisor to do one of your strategies. Okay. And let's say the advisor doesn't work with you. How would it even happen, I guess, is what I'm asking.
Yeah, got it. Yeah. So we're at all of the independents. So whether it's Schwab, TD, Interactive, Fidelity, NFS, that whole ecosystem. So if you're on Interactive Brokers, you can find us in the marketplace.
Okay.
If you're at Schwab or TD, if you have an advisor, you could ask them, say, hey, can you look up Avory strategies, Avory and Company strategies, Premier Growth, let's say, but just look up their strategies, and they would be able to just link us to those accounts pretty seamlessly. And then the paperwork would be done, with the advisor if we have like a master agreement, or with us if it's more of a different type of relationship. So we're available if they're there. But again, you have to speak to these advisors, and there's that trust factor that you have to build and process, understanding what we do, why we do it, how we do it. But yeah.
Because is your competitor almost just like ETFs in some respect? Because let's say Joe Schmo advisor, you're calling on and say, hey, we have this strategy. It's contrary. We really unique research. Here's some of our research reports. Do they sometimes tune you out because they're like, oh, I can just put it on in ETF index or?
I think again, I think why we're going down the active ETF route, specifically in that channel, right? Like if you're going directly to a family and it's a large family, they have liquidity always, coming in a sense, or in some cases we have a lot of their liquidity already. Those are a little bit easier. The battle there is, they have a legacy relationship that happens to be, hyper close to the family, and it becomes more, let's say, emotional and personal than it becomes business. And that's fine, as long as that the professional's good at what they do. On the other
Mm-hmm.
side, on the advisor channel, it becomes more friction than anything else. It's I don't want to knock down the door of all 500 of my clients and tell them to sign this paper for a 3% sliver of their overall portfolio, or a 7% sliver. So what's the easiest access point? Active ETF achieves that. The thing is, an active ETF is the most expensive product to build of all those products that are out there. A fund structure is cheap. SMA is really cheap. A mutual fund is just as expensive, but um, those registered, call it securities, are the most expensive to do because there's more legal work, ironically, to do that. So that's ultimately the friction. It's not bad. I don't see us like, once we sit down with somebody and they hear, our process, um, see what we've done historically, I think it resonates really well. Then it becomes the next step, which is how do we implement this thing? And that's ultimately, the competition we always had, which is implementation and complexity.
But when you say implementation, is it easier because of SMAs, or what do you mean by implementation?
So if you're an advisor again, and you have 500 clients and you're trying to, get Avory Premier Growth into your portfolio, if you're running SMAs, separately managed accounts, they have to sign investment management sub advisory agreements with us or the advisor, basically saying, hey, we're going into this strategy. Um, that's number one. The other side is, if you're running an active ETF, a listed security where you can buy it on the open market. There's no sub advisory agreement involved in that. So it's that agreement that advisors don't necessarily want to put in. They don't want to constantly be bombarding their client base with documents. Now, what's morphing are these model marketplaces like a SmartX out there, which is, we have our strategies listed there, and SmartX sits in between us and the advisor. So it's easy implementation for the advisor.
It's called Smart. What did you say?
SmartX.
Okay.
They're down here in Florida. They're, growing leaps and bounds. I mean, they're doing an incredible job. They handle all of the implementation and trading in between. So they're kind of this marketplace sitting in between,
Okay.
where we essentially put our models on there. We get vetted by them, and then the advisors then use that as an easier way to implement separately managed accounts, because there's essentially much less, call it paperwork, throughout that whole process and journey.
Got it. So you can get integrated with SmartX, and then the advisors, the RIAs can
Point and click.
get point and
Yeah.
click. Okay. Yeah. Have they been around for a while? I'm just on their website now.
This has really been called the last 2.5, 3 years, that we've been on it. And really, I'd say over the last 12 months, you've definitely seen an acceleration on that platform. It's pretty good. I mean, they're solving a lot of pain points.
Yeah, I never knew them. Yeah, this is interesting. So now we'll go into we'll switch from you building the business out and getting Avory and Co.'s products out there to. Are there any stocks right now? I know you do a lot of bottoms up research, top level research. Are there any ones that you're more excited about? I hate to pin you down on a few. I know we only have literally 6 minutes, so we could skip stocks. But if there's any one that you know a little more excited about, I'd love to hear about it.
Yeah. So obviously we run a concentrated portfolio, so we only have a handful anyways. So That's the good part. I think
Yeah.
there's this narrative that's out in the world today. It's not a narrative, it's reality, but it's the AI hype. And a lot of people are going after the AI hype, and we think actually maybe some of the best opportunities are the ones that are being improperly hit. So we look at a company like Fiverr, which is a leader. And again, this isn't investment advice, but but if you look at a company like Fiverr, which is being impacted due to the belief that AI is going to take away many of the roles and job functions that exist on that platform, and you're just not seeing that, specifically early days, which I think is an important signal today, because I think this is ultimately the test and trial period where probably the most, let's say, and less repeatable activity is going to start to happen. So if you were going to see on the fringe any sort of implications, I think right now is when you would probably see it. And you're just not seeing that. Actually, the opposite, where you're seeing category expansion on that platform. So it's a freelance marketplace, where designers and creators and freelancers of all types.
How'd you decide that one versus the other one that
Upwork.
Upward? Yeah.
Yeah, they just run different models, and they're kind of like converging on each other for sure. You know, Basically, if you look at Fiverr's how they built their platform, it was definitely more of a catalog where you know what you're getting up front. You're getting a I don't know a podcast opening edit for $20, right?
Okay.
And that's what you're going to get. You're going to get it in 3 days, and this person has 200 ratings and 5 stars across all those. You click it, you buy, right? It takes instant second, and you can use it. Upwork is more of you put a request in, and people bid for your work. And so it's different types of jobs. We actually like the catalog, and then morphing into some of the bidding that they're doing,
Okay.
and moving up market in terms of enterprise marketplace of what they're building out. So that was kind of the difference there. You also had, Upwork was a conglomerate, or a couple companies put together, 7 years ago, 8 years ago, and a new leader, within the last 4 years. So it's a little bit less. It's a great company. It's a great product. But at the same time, it's not Mika Kaufman, who the founder CEO has been through many of these different waves. They went from selling $5 items to, the other day having a $10,000, AI project built off using one of their freelancers for storytelling, that they highlighted in kind of their earnings report. But
Really?
anyways, yeah, we think it's a fascinating company. It's horizontal, so they're not like pigeonholed to anything. So as the digital world kind of morphs, the talent morphs with it. And I don't know, like, if you're trying to build something AI today, where do you go? Where do you get a freelancer to help you to build, to connect two APIs, one to, OpenAI and one to here? The first place you can really go are to these freelance marketplaces or a friend that you know.
No, I think it's no break. I mean, yeah, and I do like how Fiverr has those prices versus Upwork. You have to do a little more work for your posting, but that is one that those stocks did take a hit, and I think those ones will always be around, and they're the ones who can help bridge the gap, not just for building websites, but data, a lot of stuff, lead gen, and
Yeah,
you
everything.
know, um, that is a good one. And I know you have a lot of other ones. I saw in your report. I mean, if you guys Google Avory and Co, we'll have links to on the Benzinga website as well. Um, let's say this is part one of our show, because we're going to do a part two where we just talk more stocks. I know we talk more about his business, but it's awesome seeing people build businesses different ways in the money management space. You said you're working on an active ETF. When you have that, we'll have to get you on the show and market it to our listeners. I know you have your own podcast. What's the name of it?
Yeah, inside scoop.
Inside Scoop. How often do you give the Inside Scoop?
Yeah, look, it's I'll give you a 10-second highlight. We bring on all types of guests. Generally speaking, top of mind, ideas in the marketplace. Meaning, if AI is top and or front and center in the world, we had the ServiceNow CTO or head of AI, the Nutanix CTO on there talking about some of the generative AI stuff they're doing. So we're just bringing our investments, our ideas, what's top of mind in the world, closer to the investors through people that are inside of it. Gives us good insights, gives hopefully the listeners good insights. So it's on YouTube, our Avory channel, Avory Co channel, and all the app stores, Spotify and Apple. So that's
All right.
ultimately what it is.
So hopefully we brought you some new listeners. Sean Emory, you can follow him on Twitter. But just look up, go to Avory Co. or your Twitter. What's your Twitter name? I know it. It's underscore Sean David, SeanDavid. And there, go to the link tree. And that's where you see this research report that I'm looking at. It's called the latest investor memo. It's pretty sweet, actually. So it's an idea day event. Like you're with it, social media. You work hard, don't you?
We work hard, and then we put it all out there. So,
So
generally speaking, what you see is what we're doing.
You have no time for golf.
Zero golf. My friends
shit.
always,
Come on.
man.
Isn't that where you raise all the money? The big golf, the 2 hour, 4 hour round. So not yet. You're out there.
Not yet.
It's all out there. He has it all out there. You're on the line, which most people don't put it themselves out there. So that's why it's really nice having you on. Appreciate you coming on the Raz Report. We will have a part 2, and we'll talk more stocks. Again, Sean Emory, thank you for coming on, and look forward to being in touch.
Love it. Good stuff, Jason. Have a good one.
Thank you.